Well, g'day there, traders and friends, market participants right around the world. I just wanted to take a moment of your time and just go through a couple of things which I think is noteworthy and something that you should be thinking about, paying attention to, at least be cognizant of as we move into the week's worth of trading, which begins on Monday, the 7th of November. A very interesting week outside of trading, obviously, with US presidential elections taking place on Tuesday. We should understand who the next president will be late Tuesday evening, if not into the wee hours of Wednesday, depending on how tight the election truly is. Polls are very close, or they appear to be very close. It'll be very interesting to see the resolution and to finally understand who the next president of the US will be. That, of course, is going to usher in most likely volatility between Tuesday and Wednesday's trading session. However, notwithstanding that piece of noteworthy news or a noteworthy occurrence which is bound to take place this week, let's talk about some of the technical, structures and key breakdowns taking place. Very important for you to understand this. And again, just to take note of it, because we could be at some form of a tipping point really at the current juncture right now. So without further ado, let's move into the Russell 2000. The Russell 2000, why are we starting with this particular market? This market here has been the market which has tipped us off to a lot of the weakness which we've seen across the board when discussing and analyzing the US financial markets. We've been really toying around this 1210 area. We've definitively closed below and of course pushed below 1195. We've seen the continuation. It has been relatively weak sell-off in terms of a material correction. We are down anywhere between 3 and 5% across the board in the equity markets, but the Russell's really coming back down into macro support once again. We've highlighted and defined 1,150 as our target on the Russell. What you should be paying attention to right now is the bounce. As a lot of people turn bearish and again they sort of turn defensive or cautious on the market, we'll generally see a bounce, and that bounce will take the markets back up and retest the pivot, right? The pivot point is the old support, which is bound to act as new resistance. So as these markets move into a very oversold territory, as you can see on the stochastics here, we're starting to see it cross up from oversold territory. RSI is turning back up, and the MACD, again, not all that stretched, but it is ushering in, or at least the fast line is starting to turn up and adjust. It will coincide with the bounce across the board in the equity markets. When we apply this through to the S&P and the Dow Jones Industrial Average, you can see that the S&P is very close to the 200 simple moving average. We have at least set up a downward sloping trend line here. If you start connecting some of these lower highs, you can see that we at least have 3 touches. On a number of occasions, when this market continues to gap up, it is sold, and we have definitively broken again that old structural support, which is bound to act as new resistance. On top of that, not only do we have horizontal resistance, we also have that downward sloping trend line. So at some point in the near future, most likely, when we see this bounce, it is very important to understand, or at least assess, what is going on around the bracket, close to 2140 all the way down to about 2130, if not 2120 on the S&P 500. Again, applying this to the Dow Jones Industrial Average, not as much of a sell-off compared to that of the S&P 500, but we have closed below the September and of course the October lows a couple of months ago, and you can see that we do have upper wicks. Even on Friday's candle, we have that upper wick indicating selling pressure. The Dow Jones Industrial Average has a little bit further to drop to hit that 200 simple moving average, but when we have a look at the overbought, oversold nature of the market, we are, according to the RSI, relatively oversold. In fact, to go back in time to see these markets, just how stretched they are, we have to go back to, of course, the Brexit historical vote back in June 2016 to see the RSI back down at these historical lows. We did see a quick snapback very briefly in September. However, the markets have been stagnant. They have been moving sideways for roughly 4 months right now. So where's this analysis leading us? We've got a mix between the S&P, the Dow. I've touched on the Russell 2000. It has been sort of the golden key for us to at least expect a pullback. We have been looking at these markets as well in terms of a Bollinger Band squeeze. That has definitively broken to the downside. We also have the NASDAQ holding up on this intermediate trend line, which is interesting. When we pay attention to the Dow, we have closed below that intermediate trend line. So you see this trend line right here, it has broken. And targets for us are coinciding with that big primary trend line dating back to 2009. So I mean, more so on an intermediate level, we are looking at price coming back down to this target on the Dow, close to 17,000, and retesting that primary trend line on the S&P 500 anywhere between 2050 and 2000 is a good sort of macro intermediate target right here across these two markets. But the Nasdaq is already positioned on that intermediate trend line, and it is now the third touch. Having said that, when we have a look at chart patterns, isn't this quite interesting? It looks as though we're establishing a left shoulder over here. We have some form of a head being developed, and if we do see that bounce, it is key right now to assess what happens around 5,200, even as low as 5,150. That inevitable bounce is coming, and most likely it may begin this week. But if we fail to produce a higher high, that will be devastating for the bulls out there, because what will happen is that we'll come up, we'll fail, and then ultimately we will crack that intermediate trend line, and that will mean all three markets have broken that intermediate trend line. And on top of that, we have got terminal reversal patterns setting up not only on the daily charts but also on the weekly and the monthly charts. If I start zooming out and showing you some of these fractals or different fractal analysis, if we start going out to the monthly chart on the Nasdaq, as we have pushed up and made a subsequent higher high towards the end of 2016, we're just setting up divergence on the monthly charts. This is very, very bearish for the equity markets. You can see this as well across the Stokes, the RSI, and the MACD as well on the Dow Jones Industrial Average, and you're also seeing it on the S&P 500. What does this mean for the market? And I mean, how can we apply this moving forward? What do we expect, moving into the next 2 weeks, if not rounding out the year 2016? And as we alluded to a number of weeks ago for the Russell 2000, if I bring that market back up, showing the initial stages of weakness and how it was starting to crack the structural lows prior to the S&P and the Dow and the Nasdaq breaking their structural lows, the next market you really need to pay attention to this is the Nasdaq 100. If anything, we can really say that this is in many ways a hybrid between the three widely followed US indices. When I say that, I mean the S&P, the Dow, and the Nasdaq, because when you look at these three markets over here on the left-hand side of my screen, they are somewhat mixed. Yes, they are moving into corrections. However, the stage of the correction is a little bit different depending on the market which you're looking at. When we pay attention to the Nasdaq 100, it is highlighted absolutely brilliantly. It's terrific. It is beautiful in terms of technical analysis. The reason why I say that is because we have pushed on up. I'll zoom out so you can see the picture. We've pushed on up, back up just shy of 4,900 on the relative indice. But we've seen, again, multiple exhaustion gaps. You see this gap right here and also this gap over here where it was leading towards a breakout, a sustainable breakout, even though we weren't jumping on board with it because the CCI was pushing back down below that positive 100 area and the ADX didn't support the trend. Well, based off these exhaustion gaps and the chart pattern and the reversal gap and this neckline which is developing around 4,660, it's starting to become really blatantly obvious that we're setting up a head and shoulders chart topping pattern on the Nasdaq 100. And what that means right now is that we are at the pivot point. We are at the structural support level where we expect price to bounce. What you should pay attention to at this particular point is, well, what happens with that bounce? Does the bounce break above the high which we've established in mid-October? If that is the case, we want to see confirmation across the board with the S&P, the Dow, and the Nasdaq. And listen to me very closely here because this is very important. If we see the bounce and it fails just shy of 4,850, anywhere below 4,900, and it starts to turn down again, well then we are coming back down to, and if I zoom out and show you this, the lows down here at 4,200 on the Nasdaq 100. It's a big call, I understand that, but when we go back out and zoom out, this is the weekly chart going all the way back to 2009, the beginning of the current bull market. The bull market advance, which has lasted, 7, 8, 9 years? It looks as though it's exhausted, right? It looks as though it's exhausted. And all of these candlesticks up here on the weekly chart, these engulfing candlestick patterns on top of those negative divergences, which we've seen as the market has pushed on up once again. Another market showing multiple points of negative divergence or bearish divergence when you look at the MACD again pushing up in August, failing to continue in the month of September and October, turning down with that lower sloping MACD. These are all telltale signals that yes, the ship is starting to turn, yes, it is starting to reverse. It's just a process, and a very timely process. It can take as long as it wants. But right now, at the current juncture, we are at a very, very important time across the board for these financial markets, and you need to be made well aware of that. If I zoom on back out to the daily chart, why is this 4,200 level so important? Why is it? It's because it's horizontal support over here, and it's also most likely going to coincide with that long-term primary uptrend. So it's sort of as if X marks the spot. And from time to time, when I go through analysis with people in Pivot Point Pro, I'll come up with the phrase X marks the spot, and it's really just multiple points of support, right? Or multiple points of resistance. If that is the case, then zoom out another fractal, even on the daily time frame. And what I mean a larger fractal is that just incorporating a little bit more time, is that if we start going back to March 2016, progressing through to July 2016, we can see the breakout which has taken place. This would then look like a macro, again, head and shoulders chart topping pattern. What would happen? We'd see the equity market, or at least the Nasdaq 100, come back down to where X marks the spot, and then it would be the subsequent bounce. If that failed again, then you'd be looking at the final head and shoulders chart topping pattern and the structural break of that long-term primary trend line, and then that would be it for the market. This is the line which differentiates that between of a bull and bear market. At the moment, it looks as though we're entering into an intermediate correction back into that primary trend line. Along with, or coinciding with that intermediate correction, we will get minor bounces back and forth. It will be swings up and down in daily momentum or weekly momentum. We'll see some weeks go to the downside. We will then obviously set up bounces, which is what I'm sort of calling for, at least open-minded to, moving into the next week or two's worth of trading. But what I'm trying to emphasize right now, if you're listening to this YouTube update, is that don't be swept up in the emotion of trading. Don't be swept up with the bull market advance at this point. These equity markets look stretched. They look overvalued, and they just look exhausted. And just to show you this in detail, we've been moving sideways more or less for 2 years. This equity market is failing to produce sustainable higher highs, and we're getting closer and closer and closer to breaking that third decelerating fan line, or the fourth decelerating fan line on the Dow Jones Industrial Average. Market breadth, market internals are turning heavily negative, and it's not a time to be complacent. It's not a time to keep your head in the sand. And interestingly enough, on Thursday on the S&P 500, it was the 8th consecutive daily loss. And the last time we did that was 2008. Obviously, on Friday, we closed below the close on Thursday. That is the 9th consecutive losing streak, or daily losing streak for the S&P 500. We have to go back to the year 1980 to see that same daily occurrence. That's 36 years ago. If this continues through to Wednesday, say for instance, Monday and Tuesday are negative days, and then the market reacts negatively or adversely to the next president, well, then we'll be going back to 1966, and that marked the top of the bull market advance, where the Dow Jones Industrial Average peaked just below 1,000, and I believe it took another 18 years until the Dow Jones Industrial Average breached 1,000 and continued again its macro bull market advance. Just to put this in perspective for you, going back in history actually, this is what I'm talking about, the top in 1966. And if I drag this across, you can see that we touched it on multiple occasions. Let me zoom out for you. Zooming out. I need to just add a little bit more time so you can see this. There we go, that makes it look a little bit better. That's 1966 over here, and we failed to hold above 1,000 until late 1982, and then that was the subsequent bull market advance for the next 18 years through to the peak in the year 2000. So there are a lot of parallels going on, interesting parallels. I'm not sure whether or not there's all that much merit to it, but when you come across these golden nuggets, it's good to share with people, and again to try and put this in context of, look, we've come a long way since 2009. I think we can all agree on that. And with so many points of bearish divergence and a bull market which is just teetering on the edge of that primary bullish advance, with internals looking so negative and potentially some form of a big shock to the market potentially upcoming, it might be the right time to at least reassess your long-term perspective on the market, and potentially factor in some what-if scenarios if some certain key areas of support is breached or are breached across the board on these markets. If that is the case, I will update you on that. If you'd like to learn more, have a look at Pivot Point Pro. Other than that, everyone right around the world, it is James signing off on behalf of Pivot Point Trading. Have a fantastic weekend, everyone. I'll be back with you during the week, most likely on Wednesday, in response to the market's reaction to the new US president. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.